Okay, let's unpack this. Today, we are undertaking a deep dive into the hidden machinery of financial services.
Yeah, looking beyond the products themselves.
Exactly. We're focusing on the underlying systems, the vital role institutions like, say, banks and building societies play in keeping the economy stable and, well, how they manage risk for you.
Absolutely. We've got some great sources here that really help understand the essentials, how money moves, who's moving it, and importantly, the safeguards that are in place.
Because these institutions, they weren't just selling you things.
No, not at all. They're the connectors, really, indispensable connectors in the economy.
So our mission today is to get a quick grasp on how these connectors actually work. And that really starts with the basic idea, doesn't it? Intermediation.
Intermediation, yes. It sounds complex, but it's simply linking two main groups in the financial world.
Right, you've got people or firms with extra cash.
The surplus sector, yeah.
Yeah.
They want to save that money and ideally earn some return on it.
And then you've got the others who need cash.
The deficit sector. Could be businesses needing investment, families needing a mortgage. They're willing to pay interest to borrow that money.
And the financial intermediary, the bank or whoever, sits right in the middle.
Bang in the middle. Managing that whole relationship.
And making a profit from the difference in interest rates.
That's the margin, yes. They borrow from the surplus sector at, let's say, a lower rate and lend to the deficit sector at a higher rate. That difference, that spread, is how they primarily make their money.
Okay, but hang on. If it's just about profit, why don't the savers just lend directly to the borrowers? Cut out the middleman.
Well, that's where you see just how useful these intermediaries are. They actually solve four pretty fundamental problems.
A problem.
Four, yeah. Problems that would make direct lending really difficult, maybe almost impossible on a large scale. The economy could just seize up without them.
Okay, so what are these four invisible problems financial services are solving?
Well, first, they solve geographic location. Think about it. Our sources mention, like, a saver up in Yorkshire and someone needing a mortgage down in Essex.
They're never going to meet.
Exactly. But the bank, or building society, bridges that physical gap. It allows capital to flow where it's needed, regardless of geography.
Okay, makes sense. What's number two?
Aggregation. This is about size mismatch. Most people's savings deposits are, relatively small. The average is often under £1,000.
Right, not enough to fund a big business loan or even a whole mortgage.
Precisely. So the intermediary pools millions of these small savings together. They aggregate them to create the large sums needed for lending. Micro savings become macro loans.
Okay, geography and size. What else?
Maturity transformation. This tackles the timeline problem.
Ah, right. I might want my savings back in 6 months.
But the business borrowing the money needs it locked up for, say, 10 years for a project. That's a mismatch in the term, the length of time.
So how do they handle that?
They offer a whole range of deposit accounts, instant access, notice accounts, fixed-term bonds. By managing a large pool of deposits with different terms, they can manage the risk that too many people will want their money back all at once. It lets them lend out long-term while still offering savers shorter-term access.
Clever. Okay, that's three. What's the last one?
And this one's maybe the most critical for stability. Risk transformation.
Risk.
Yeah, think about it from the saver's perspective. Would you lend all your savings to just one person or one business?
No way. If they defaulted, I'd lose everything.
Exactly. That's too much risk for one individual saver. But the intermediary, the bank, lends to hundreds, maybe thousands of different borrowers.
Ah, so they spread the risk.
Precisely. It's the portfolio effect. Some loans might go bad, sure, but those losses get absorbed across the whole portfolio. The intermediary transforms that high individual risk into a low, manageable, aggregated risk for the system.
So intermediation is really about managing these fundamental mismatches, geography, size, time, and risk.
That's it in a nutshell. It makes the whole system work much more smoothly.
Okay, so if that's intermediation, what about the opposite, when the middleman is cut out?
Well, that's disintermediation. It happens when lenders and borrowers, or maybe investors and companies, connect more directly.
Like a company issuing shares directly to the public.
That's a classic example, yeah. They're raising funds directly from investors. Now, a financial firm might still be involved.
But not as the lender taking the margin.
Right. They might be there to help with the process, advising, handling the paperwork, that kind of thing. But they charge a fee for that service, not an interest rate spread. It's a service payment, not a lending profit.
Got it. So we know they do intermediation payments Safekeeping, maybe insurance stuff too.
Yeah.
Let's talk about who owns these places, because that structure matters, right?
Oh, hugely. If you look at the main players, banks, building societies, insurers, they mostly fall into two camps regarding ownership. The majority of the big UK institutions are shareholder-owned organizations. Think of your typical large high street bank listed on the stock exchange.
Owned by shareholders who expect dividends and get to vote on who runs the place. Their main loyalty is to the shareholder return.
Legally, yes. Maximize shareholder value. But then you've got the other model, mutual organizations.
Mutuality. That sounds different.
It is. Fundamentally, mutuals are owned by their members. There are no external shareholders pulling the strings.
So who are the members?
Depends on the organization. For a building society, typically the members are the savers and the borrowers.
So the customers are the owners.
Essentially, yes.
Yeah.
And they usually determine the management through general meetings. It creates a very different dynamic.
I bet. The priorities must shift. If the owners are the customers, maybe they care more about good service or lower borrowing rates than just pure profit.
That's the traditional argument for mutuality, yeah. The focus is meant to be on member benefit and stability rather than just shareholder returns. Examples include building societies, friendly societies, credit unions, and even some life insurance companies.
But didn't a lot of building societies stop being mutuals? That whole demutualization thing?
Ah, yes. That was a big wave, particularly after the Building Societies Act in 1986 allowed it more easily. Many large building societies converted into banks became public limited companies, PLCs.
Why would they do that? Give up member ownership?
Well, there were strong incentives. Becoming a bank often allowed them to do a wider range of business activities with fewer restrictions. And critically, the conversion often came with a big cash payout, a windfall to the members at the time.
The money talks.
It certainly did for many members, but it marked a significant shift away from the mutual model towards shareholder ownership in the UK financial landscape.
Talking of pure mutuality, though.
Yeah.
Credit unions fit that bill perfectly, don't they?
They really do. They're financial cooperatives, owned by the members, run for the members, and usually the members share some kind of common bond, like living in the same area, working for the same employer, belonging to the same club.
And their original focus was quite specific, wasn't it?
Very much so. Historically, they aimed to tackle financial exclusion, providing basic savings accounts and affordable loans, often to people who might have struggled to get those services from mainstream banks.
And are they still relevant?
Absolutely. Many have expanded now. They might offer basic bank accounts, insurance products, sometimes even mortgages. They play a really important role still in serving communities and often providing financial education, too.
Okay, so we've got different ownership models. What about the type of business they do? I've heard of retail and wholesale finance.
Yeah, that's another key distinction. It's mostly about the size and type of customer.
Retail finance is us, individuals, small businesses.
Pretty much. Smaller transaction sizes. Everyday banking stuff. Deposits, personal loans, mortgages, payment systems, usually delivered through the channels we all know, branches, call centers, online banking, high street banks, building societies.
And wholesale finance.
That's the big league. Much, much larger transactions. The clients here are large companies, governments, other financial institutions.
And banks use this market themselves, right, to raise money.
Exactly. Banks and building societies raise a significant chunk of their funding in the wholesale money markets, borrowing large sums to supplement the deposits they get from retail customers.
Is the profit margin different?
Generally lower on wholesale deals, yeah. Because the scale is so huge, the margins tend to be thinner. It's more of a volume business.
And our sources actually put a number on that for building societies.
They do. Building societies are generally permitted to raise up to 50% of their funding from wholesale markets.
50%. That's quite a lot.
It is. And interestingly, legislation back in 2007 gave the Treasury the power to potentially increase that limit even further, up to 75%, showing how important wholesale funding can be for these institutions' stability and ability to lend.
Okay, this distinction between retail and wholesale and the reliance on wholesale funding, that feels important, especially after the financial crisis.
Hugely important. Because the lines between the two were blurring and the risks from the wholesale and investment side started to spill over and threaten the retail side. That led directly to a major safeguard.
You're talking about ring fencing.
UK retail ring fencing, yes. Introduced by the Financial Services Banking Reform Act 2013, a really significant piece of regulation.
What does it actually do? for me as a saver?
Okay, so the largest UK banks that have both retail and investment banking operations are required to separate their core retail banking services, things like your current account, your savings account, into a legally distinct entity, a ring-fenced bank.
A separate box.
Kind of, yeah. A separate legal entity. And that ring-fenced part is prohibited from doing most of the riskier activities associated with wholesale and investment banking.
So my deposits can't be used for their trading activities.
Exactly. It creates a firewall. The idea is to prevent the bank from using your insured retail deposits to fund its riskier investment banking activities. And crucially,
Yes.
if the investment banking side gets into trouble, it can't automatically drain funds from the retail side to bail itself out. It protects everyday depositors and the basic banking system from shocks originating in the riskier parts of the financial world.
So it's about stopping contagion, keeping the essential plumbing safe.
That's the core idea. It forces a separation and aims to make the system more resilient.
Right. Let's shift gears slightly to the actual movement of money. Money transmission.
Getting cash out, paying
Right.
bills.
Direct debits, standing orders, transferring money online, all that stuff. The engine behind this is usually the current account, isn't it?
It is. That's the transactional hub for most people. Allows cash withdrawals, check payments, electronic transfers. Often comes with an overdraft facility, too.
And competition means lots of them are free these days.
Well, free at the point of use, mostly. Intense competition led to that, though you also see premium accounts with monthly fees that bundle in other benefits like travel insurance or breakdown cover.
But when I pay someone, say, electronically from my bank to theirs, there's a whole process happening behind the scenes, right? Something called clearing.
Yes. Clearing. It's vital, but totally invisible to most users.
So what is it?
Okay, think about all the millions of payments happening every day between customers of different banks. You pay someone at Barclays from your NatWest account, someone else pays you from HSBC. It's a constant flow back and forth.
Seems complicated to track.
It would be if they settled every single transaction individually. Instead, at the end of the day, the banks calculate the net amount they owe each other. So after tallying up all the payments in both directions, maybe NatWest owes Barclays a net $10 million overall for that day's business.
They just settle the difference.
Exactly. They calculate the net figure, and then that final net settlement happens through special accounts that the banks hold at the Bank of England. It massively simplifies the process.
Okay, so that keeps the money flowing efficiently. But who makes sure this whole payment system works properly? That it's safe, reliable, fair?
That's the job of a specific regulator. The Payment Systems Regulator, or PSR.
PSR.
Yeah.
Okay. Are they part of the Bank of England?
No, they were set up in 2014, operational from 2015, as an independent subsidiary of the Financial Conduct Authority, the FCA.
So the FCA looks at how banks behave generally, and the PSR focuses just on the payment systems themselves.
Precisely. The PSR's specific job is to oversee the payment systems infrastructure. Their mandate is to make sure payment systems are accessible, reliable, secure, and value for money.
And they have specific goals.
3 statutory objectives, yes. To promote competition between payment systems, to promote innovation, new ways to pay, and, crucially, to ensure the systems operate in the best interests of the people and businesses that use them and the UK economy as a whole.
So they're like the guardian of the financial plumbing.
That's a good way to put it. They're watching over everything from huge interbank transfers down to you tapping your card for a coffee.
Wow, okay. We've covered a lot of ground, starting with why we even need intermediaries solving those 4 big problems.
Geography, aggregation, maturity, and risk.
Then looking at who owns them, the shareholder model versus the mutual model, like building societies and credit unions.
And that crucial safety net introduced after the crisis.
Retail ring fencing, separating everyday banking from riskier activities.
And finally, how the money actually moves. The clearing system and the regulator watching over it all, the PSR.
I think the key thing for you listening is that all this complex machinery, this infrastructure, it's fundamentally about managing risk and ensuring stability.
Yeah, understanding these roles, the intermediaries, the regulators, shows how these vast sums of money, from your savings deposit right up to huge government transactions, are supposed to be managed and protected. It's designed to keep things flowing.
So here's something to think about, drawing on what we've discussed. We heard how mutual organizations, like credit unions, are often highlighted for their role in tackling financial exclusion and providing education.
That social purpose aspect.
Right. So given that, what's the impact of the fact that the financial system is still largely dominated by huge, publicly listed, shareholder-owned institutions? Does that structure affect how well financial services reach everyone, particularly those outside the mainstream?
It's a really interesting tension, isn't it, between the different models and their priorities.
Definitely something to mull over next time you look at your bank statement.